Welcome to the Deep Dive. Today, we're diving into a pretty high-stakes moment. It's October 1st, 2025, and the U.S. government shutdown has begun. That's the third one under President Trump. And look, this isn't just politics. It's hitting the markets hard right now.
It absolutely is. And our goal today, well, it's to get beyond just the headlines. We need to unpack that immediate chaos we saw. S&P 500, NASDAQ 100 futures, they slid, 0.4%, 0.5% in early trading?
Yeah, that was quick.
But more than that, we really need to explore this this divergence. How can you have this political mess, this paralysis in the U.S., while at the same time, across the Atlantic, some really high-risk assets are seeing record rallies?
That's the core tension, isn't it?
Exactly. That's what we're digging into.
Okay, so let's lay out the immediate problem. The shutdown itself is bad, obviously. But what's really spooking the markets, it seems, is this double whammy. The political fight, Trump versus the Democrats, and then this threat of a data blackout.
Yeah, the data blackout is huge. I mean, the sheer uncertainty is just poison for financial markets. Look, everyone kind of knows the deal gets done eventually, right? But how long does it take? That's the question. And maybe even more critical, the government offices that give us the key economic numbers, like the Bureau of Labor Statistics, they're shut. So that September jobs report, non-farm payrolls, due Friday.
This Friday, October 3rd.
Yeah, it's delayed. Indefinitely, maybe.
So the Fed, investors, everyone's flying blind.
Pretty much, yeah. Flying blind.
Okay, segment one. Let's get into the political background and the tangible fallout in the U.S. First shutdown in almost 7 years. It happened because they couldn't pass a continuing resolution.
Yeah.
Which, for anyone needing a refresher, that's the stopgap bill Congress uses to keep the government funded when they can't agree on the main budget.
And the sticking points, based on the sources we looked at, they're very specific this time. You've got Democrats really digging in on extending healthcare subsidies, reversing Medicaid cuts.
Right.
And then on the other side, things took a pretty sharp turn when President Trump floated the idea of using the shutdown for mass layoffs. Not just furloughs, actual permanent job cuts for federal workers. That adds a whole new layer of economic anxiety.
Definitely raises the stakes.
Yeah.
And that brings us back to the data blackout. Bureau of Labor Statistics, Census Bureau, Bureau of Economic Analysis, BEA, they're all closed.
Yeah.
You lose your eyes and ears on the economy's health.
Totally. Think about the Fed. Their whole mandate is based on jobs and inflation data.
And they just lost the biggest piece of the jobs puzzle.
And we can actually put some numbers on the immediate pain. The estimates suggest around 750,000 federal workers are furloughed right now.
750,000. Wow.
Yeah. And the lost pay, it's estimated at about $400 million every single day.
$400 million a day.
Yeah.
Just sucked out of the economy.
Exactly. Think about places like D.C., Virginia, Maryland. The ripple effect is immediate.
That's a huge drag.
And the economic models are picking that up. Bloomberg Economics ran the numbers. They reckon if this lasts just 3 weeks, the unemployment rate, which is 4.3%, could jump to maybe 4.6%, even 4.7%, just from those furloughs being counted as temporarily jobless.
Just 3 weeks.
Yeah, and history tells us this isn't just temporary pain either. The CBO, the Congressional Budget Office, they looked at the 2018-2019 shutdown, the 5-week one. They figured about $3 billion in economic output was lost permanently.
Permanently gone. Out of an $11 billion total hit.
Right, so it's not just a pause button. There's real economic scarring that happens.
All right, let's shift to segment 2.
Yeah.
How are global markets reacting? If the U.S. economy is hitting turbulence, what's happening with the dollar, the world's main currency? Well, the reaction was instant. Dollar weakness.
Yep. When U.S. political risk flares up like this, the market reevaluates the dollar. A shutdown means slower growth, probably. Slower growth means the Fed might have to cut rates down the line.
Lower future interest rates.
Exactly. It makes dollar assets less attractive. So people sell. We heard one strategist call it a potential vicious cycle for the dollar if this drags on.
And we saw it clearly in the currency pairs, didn't we? Dollar down for the 4th day, euro pushed higher, euro USD around 1.104.
And the yen gained too, another safe haven move. USD JPY dipped about 0.5% near 147.04.
Okay, so currencies tell one story. What about stocks and just the general market mood?
Well, the shutdown definitely put the brakes on that big U.S. stock market rally we've seen. S&P 500 was up, 14% for the year?
Yeah, been a strong run.
But futures turn negative pretty fast.
Yeah.
And you see the uncertainty reflected in the VIX, the volatility index.
The fear gauge.
Right. It popped up over 3%, hitting around 16.77. That signals rising anxiety.
And rising fear usually means a flight to safety, right? Gold.
Absolutely textbook. Gold prices hitting record highs. We're seeing quotes near $3,900, even $4,000 an ounce.
Wow.
When investors face this kind of political mess and, crucially, this information mess, they want something tangible, something universally seen as valuable. That's gold.
So if we look at those sentiment indicators, like the fear and greed index components.
Yeah, all the signals are pointing towards fear taking over. Rising VIX, money moving into gold, preference for bonds over stocks. It all points to investors quickly reducing risk, pulling money out of U.S. stocks, waiting to see how this plays out.
This volatility, this data vacuum, it puts the spotlight straight onto the central banks, doesn't it? In segment 3. And the main headache, obviously, is for the Federal Reserve.
Oh, completely. It's an agonizing spot for the Fed. They always say they're data dependent.
And now there's no data.
Exactly. So it's created these two sort of competing theories among analysts about what they do next.
Okay, what's theory 1? I heard some speculation, maybe a bit wild, that this shock could force a bigger rate cut, like 50 basis points.
Yeah, that's one line of thought, that the economic hit plus maybe Trump's talk of layoffs could spook them into a larger, faster cut.
But that sounds like reacting to politics, not data. Isn't that risky for the Fed?
It does seem risky, and that's why the counter-argument feels maybe more plausible, which is, if you have no data, the most prudent thing might be extreme patience.
Just wait.
Yeah.
Delay any planned cut.
Yeah. Why make a big move based on guesswork? Maybe just push any decision past the October meeting, wait until the picture clears up. Data integrity might trump a speculative cut.
Okay, that Fed dilemma is a stark contrast to what's happening in Europe, right? Policy seems much clearer there.
It really does. We just got the September inflation numbers for the Eurozone. The CPI came in at 2.2% year over year. Accelerated a bit, but bang on expectations. Driven mostly by services, some energy effects.
So no surprises for the ECB, the European Central Bank.
Nope. And this data just reinforces their current stance. They seem comfortable with their main rate at 2.0%. They're saying inflation risks are contained. Their forecasts look pretty stable too, expecting inflation to dip next year, then level out.
So while the Fed's in limbo, the ECB has clarity.
Pretty much. Policy clarity versus data paralysis.
And we also heard from the Bank of England, from Catherine Mann.
Yeah, she's generally been one of the more hawkish voices there. She's still pushing back against recent rate cuts. Her argument is that UK policy is still relatively loose, and they need to keep rates at 4.00% because UK inflation is stickier.
More persistent risks there.
Right, and the market seems to agree. It doesn't seem much chance of more cuts from the BOE this year.
Okay, this is where the story takes a really interesting twist, segment 4. While the U.S. is tangled up in this shutdown drama, some parts of the European financial world are showing, well, surprising strength, especially in a pretty risky asset class, additional Tier 1 bonds.
AT1s.
Yeah, AT1 bonds. These are high-risk bank debt. Remember, they can be wiped out or turned into equity if a bank gets into trouble.
They got notorious after the Credit Suisse collapse in 2023, right? Everyone was terrified of them.
Exactly. Huge fear factor.
Yeah.
And yet, right now, this exact asset class is having a record-breaking run. They've rallied over 57% since hitting those lows post-Credit Suisse. 57%. That's massive.
It's the biggest rally ever for AT1s, bigger even than the recovery after the pandemic crash.
Wow. Okay, that seems completely counterintuitive. Global uncertainty is rising, the U.S. is shut down. Why are investors suddenly piling into risky European bank debt? Has the risk just vanished?
It's not that the risk vanished, but it signals huge confidence in the banks themselves. It's a vote for the fundamentals, the performance of the European banking sector right now. Our sources point out European bank stocks are actually outperforming U.S. banks.
Even outperforming the big U.S. tech stocks, the Magnificent Seven.
Apparently so. And you see the demand when new bonds are issued. RCI Bank tried to sell 400 million of these AT1 bonds. They got orders worth 18 times that amount.
18 times oversubscribed. Incredible.
Yeah. Demand is just off the charts because investors seem to genuinely believe these European banks are solid, profitable, and well capitalized right now.
So European banks looking strong just as the U.S. government stumbles. But this strength is actually causing some friction, isn't it? Some regulatory pushback.
It is. There's a brewing conflict we need to watch. The U.S. is putting pressure on the Basel Committee. That's the group that sets global bank rules.
Right, the Basel Committee on Banking Supervision.
Yeah. The U.S. wants them to undo a rule change from 2022. That change basically helped big Eurozone banks like BNP Paribas by letting them treat the entire Eurozone as one single home market when calculating capital buffers.
Specifically for their GSIB surcharge, right? The buffer for globally systemically important banks.
Exactly. Treating the Eurozone as one domestic market lowered the extra capital buffer these huge European banks had to hold.
Makes sense. So the U.S. wants that reversed.
Yes. And if the U.S. succeeds, it would force these European giants to hold more capital again.
Which could potentially dampen this rally we're seeing in their stocks and bonds.
It definitely could. So it's this interesting geopolitical angle. The U.S. actively pushing global rules in a way that could disadvantage strong European competitors, even while its own government is shut down.
So let's try to wrap this up. What does this all mean for us watching the markets? We've really seen two clashing stories emerge today, October 1st. On one hand, you have this deepening uncertainty from the U.S. political gridlock, data disappearing, dollar weakening, volatility spiking.
Self-inflicted wounds causing global ripples. But then, on the other hand, you see this remarkable resilience, even confidence, in parts of Europe. The ECB seems steady, policy is clear, and European bank debt, even the risky stuff like AT1s, is surging on strong fundamentals. It's like a decoupling, almost.
So maybe a final thought to leave everyone with. The shutdown is causing immediate economic pain inside the U.S. and headaches for currency traders globally. That's clear.
Yeah, the short-term impact is undeniable, but at the exact same time, the U.S. is still wielding significant power on the global financial stage. Pushing back on things like that Basel rule shows that the bigger strategic geopolitical battles over financial regulation and dominance, they continue. They're happening whether Congress has its lights on or not. The fight for financial influence doesn't stop for a shutdown.
A fascinating contrast, politics versus finance, playing out in real time. Keep exploring that interconnected world with us. We'll see you for the next deep dive.